One of the most common questions we get right now is this: what happens if the market crashes and you're already retired? Not 5 years from now, not hypothetically, but right now, when there's no paycheck coming in. Because it's one thing to say that you're comfortable with market volatility while you're still working, but it's very different to watch the market fall when you're actually living off your investments. So today, we want to walk you through exactly how we handle market downturns in our early retirement. Not in theory, not in a calculator, but in real life. No panic, no guessing, and no pretending that it doesn't matter. Just a plan that's built specifically for the years when markets don't cooperate. And the biggest mistake that people make in early retirement isn't the market dropping. It's being forced to react when it does. So market downturns always feel uncomfortable, but they feel very different once you retire. When you're working, you're still contributing, you have income coming in, and down markets feel abstract. But when you're retired, you're withdrawing. There's no paycheck behind you, and headlines suddenly feel personal. And that emotional shift is real. And ignoring it is how people make bad decisions. So the goal in early retirement isn't to eliminate volatility. That's impossible. The goal is to remove the urgency. For anyone new here, welcome. We retired early at 53 and 55 with no pension, no inheritance, and no outside income streams, and no safety net beyond what we built ourselves. Everything you're about to hear is based on money that we've earned, saved, and invested over decades. Here's the rule that governs our entire retirement plan. We do not sell growth assets in a down market. And that's it. That's the rule. Everything else in our strategy exists to support that one decision. If you're forced to sell stocks during a downturn to pay your bills, you don't have an investing problem. You have a liquidity problem. Now let's talk about how we actually set this up. Our bridge account currently sits at about $412,000. But the most important thing isn't the total. It's how that money is divided. Because early retirement doesn't fail because people spend too much. And it doesn't usually fail because markets don't recover. It fails when people are forced to sell stocks at the worst possible time just to pay your bills. That's the problem that our bridge account is designed to solve. We keep about 3 years of living expenses in SGOV, which is a short-term U.S. Treasury ETF. This money is not invested for growth. It's invested for certainty. SGOV holds Treasury bills that mature in months, not years. So that means that there's very low volatility, high liquidity, and returns that track short-term interest rates. In real-life terms, this is money that is there when we need it, no matter what the stock market is doing. And in early retirement, that matters more than chasing the extra percentage of returns. Here's the mistake that we see over and over. People do everything right for decades. They work, they save, they invest. And they follow advice from people like Dave Ramsey and Warren Buffett. And then they retire, without a plan for what happens when the markets fall. We're not new to this. While we were investing, we've lived through the 2008-2009 financial crisis, the European debt crisis, the 2011 US credit downgrade, the 2018 market sell-off, the COVID crash, and the 2022 bear market. And we didn't just live through them, we learned from them, especially what not to do. Most mistakes happen on the way down, and even more happen before people realize the recovery has already started. Over time, something shifted. My husband actually came to love red days in the market, not because losses feel good, but because red days are when the businesses we believe in go on sale. When markets are down, we're not selling VOO, we're not selling BRBK, and we're not scrambling. We're holding, and sometimes buying more. So that mindset is only possible when you're not forced to sell to fund your life. SGOV is what makes it possible. Now here's what doesn't happen when the markets fall. We don't rebalance emotionally, we don't change strategies, and we don't rush to do something. Here's what does happen. We continue living off from our SGOV. That's it. The markets could be down for months, even years, and our day-to-day life doesn't change. The bills still get paid, travel still happens, and groceries still get bought, because none of that is coming from volatile assets. Now here's the other half of the plan, and it matters just as much. When markets recover and we have strong growth years, we peel off gains. So what that means is that we're selling some growth assets after recovery. We're refilling the SGOV bucket, and we're resetting our runway. This keeps our liquidity buffer full without selling at a loss. It's boring, it's disciplined, and it works. Now this is where flexibility comes in. If markets were down for an extended period, we still have options. Our SGOV buffer gives us time. Our spending is flexible, and starting in 2030, we have the option to withdraw from my husband's rollover 401k. And that optionality dramatically reduces pressure on the bridge account. It means the bridge could last indefinitely if needed. And that's not our backup plan, that's an intentional design. People often ask us, aren't you scared you'll run out of money? And the honest answer is no. Because we're not reckless, but we're also not afraid. Because fear usually comes from fragility, not the numbers. Our fixed costs are low on purpose. Our debt is zero on purpose. And our plan has buffers and options. Early retirement for us is not a rigid finish line. It's a flexible phase of life. Now, if you're planning early retirement, here's the takeaway. You don't need to predict the markets. You need to design a plan that doesn't require prediction. So what that means is separating spending from growth, building real liquidity, reducing your fixed costs, and giving yourself time to wait out volatility. The calmer your structure, the calmer your decisions. We are still learning and we're still adjusting, and we're sharing all of it in real time with you. If you've lived through market downturns or you're worried about how you'll handle the next one, we'd love to hear from you in the comments. There are a lot of thoughtful people out there, and these conversations matter. So if you want to keep following our real numbers, our real decisions, and our real early retirement experiences, make sure to like the video and subscribe. And in our next video, we're zooming out and asking a bigger question. Retiring in America? The math isn't working anymore, because market risk is only one part of the picture, and the system itself is changing. We're glad you're here. Thanks for watching, and I'll see you in the next video.